Gold is crafted with excellence. Its timeless elegance and uncompromising quality made for the corner office. It's the ideas that inspire redefining order and elevating the tabletop. To the nines, for the leaders of today and the visionaries of tomorrow.
This is India's #1 news network, and you're watching News 9, English news as it should be.
Very good morning. This is News 9. I'm Karthik Malhotra. Thank you so much for tuning in this Tuesday morning. Well, today is a market holiday on account of Diwali, but yesterday the stock markets closed at a one-year high, buoyed by Reliance Industries' Q2 results. We'll get you all the action that unfolded on Dalal Street yesterday, and also as Samvat 2082 kicks in, the new trading year begins today. We'll tell you all the investment strategies that you should follow. And finally on the show, we will also bring you an update on Ola founder Bhavish Aggarwal, who's now in the dock over alleged harassment as per a deceased employee and his suicide note. You're watching Morning Brief at 9. This is Morning Brief at 9. First up, all the headlines this Tuesday morning. Delhi pollution on Diwali night and afterwards touches hazardous levels. NARAINA area witnesses AQI nearing 950 levels. India-EU free trade agreement talks enter decisive stages in Brussels. Minister PIYUSH GOYAL to travel later this month for what's touted to be the final round of talks. Carbon tax remains a key issue to address. But India's trade with the United States hits a tariff speed breaker. Exports to US fall to $5.5 billion in the month of September, from as high as $8.8 billion in the month of May, marking a 37.5% drop in just 4 months, as per trade data body GTRI. Stock market on Monday hit its one-year high as Reliance Industries surprises Dalal Street with better than expected Q2 earnings. SENSEX gains over 400 points, continuing with its 4-day winning streak. Meanwhile, remember, markets are shut today except for the symbolic 1-hour Muhurat trading session this afternoon. Another death by suicide attributed to work pressure. 38-year-old Ola electric engineer dies by suicide in Bengaluru. Suicide note allegedly blames founder CEO Bhavish Aggarwal for harassment. Criminal case lodged against the billionaire founder. US President Donald Trump is turning up the heat on China yet again. He has warned of a 155% tariff on Chinese goods unless Beijing agrees to what he calls a free trade deal. China's economic growth has slowed to its weakest pace in a year, with domestic demand faltering and exports doing most of the heavy lifting. Leaders in Beijing are meeting this week to shape the country's 15th five-year plan, expected to emphasize high-tech manufacturing amid rising US-China tensions. US President Donald Trump has signed a deal on rare earth minerals on Monday with Australian Prime Minister Anthony Albanese, and said Washington's key ally would get its coveted nuclear-powered attack submarines. And finally, a Samvat 2082 kicks in today. What should be your investment strategy as you begin the new trading year? We get you the biggest market voices to set your investment agenda.
एसोसिएट स्पॉन्सर बैंक ऑफ बड़ौदा के संग त्योहार की उमंग।
Well, it was Diwali yesterday, and while the lights have started fading, Delhi has woken up under a blanket of toxic haze. The air is thick, visibility is down, and pollution levels have spiked sharply after the festive night celebrations. Delhi's air quality has plummeted, pushing the city deep into the very poor as well as the hazardous categories. At ITO, the AQI this morning stood at 259. That's in the poor category, but other parts of the city are faring far worse. Look at NARAINA village, which recorded an alarming AQI of over 1,245. That's deep maroon on the AQI meter. Meanwhile, Puram has also recorded very poor levels at about 368 this morning. Anand Vihar, meanwhile, nearing the 400 hazardous levels. All this according to data from the Central Pollution Control Board. The steep rise in pollution levels is being attributed to a mix of firecracker emissions, stubble burning in neighboring states, and calm weather conditions trapping pollutants close to the ground. Now, health experts have renewed warnings that the toxic air poses a serious risk, especially for children, the elderly, and those with respiratory illnesses. Citizens are being urged to wear masks, stay indoors when possible, and avoid morning walks as Delhi continues to choke under a post-Diwali haze. They are the visuals that you're seeing from the early morning sights in Delhi. India Gate barely visible as the camera tries to zoom in and get you a visual of the magnificent India Gate covered in a blanket of haze. Early morning, look at the haze in Delhi skies. Pollution trickling back in after a weekend. You also have visuals of these haze machines which are sprinkling droplets of air to bring the pollutants down to the ground. Meanwhile, Diwali celebrations as they come to an end. The firecracker display yesterday and the stubble burning from Punjab and Haryana all causing pollution. And moving on now, the European Council has welcomed efforts to conclude a balanced, mutually beneficial and economically meaningful free trade agreement with India by the end of this calendar year. Now, yesterday it approved conclusions on a new strategic EU-India agenda announced earlier by the European Commission, welcoming the strong impetus it provides to relations between European Union and India. Its conclusions this week endorsed the joint communication on the new agenda and its objective of deepening EU-India ties, including prosperity and sustainability, technology and innovation, security and defense, and connectivity and global issues. Now, the European Council noted that closer collaboration between the EU and India on security and defense matters based on principles of mutual trust and respect were of particular importance against the backdrop of an increasingly complex geopolitical outlook. The EU area where substantial differences remain in trade and sustainable development. Even in the chapter on investment, substantial differences remain. Now, under sustainability, India's concerns on carbon tax being brought in through the Carbon Border Adjustment Mechanism or CBAM and other related regulations related to the environment remain. The EU's carbon tax is a key point of discussion in the India-EU FTA negotiations as it could impact Indian exports of carbon-intensive goods like steel and cement starting as early as 2026. Now, to mitigate this, India and the EU have reached an agreement recognizing India's domestic carbon pricing, which will allow exporters to deduct the carbon costs already paid in India to avoid double taxation, thereby easing the burden on Indian exporters. For closing the gap in the positions on the rules of origin chapter, the Indian team of officials stayed back in Brussels for talks. The rules of origin agreements specifies the quantum domestic value addition a product must have to qualify for concessional tariffs under an FTA. On market access and goods, both sides have made the expectations known for tariff liberalization, red lines and flexibilities, both on the levels of liberalization and on the staging of tariff dismantling. Now, besides demanding significant duty cuts in automobiles and medical devices, the EU wants tax reduction in other products like wine, spirits, meat, poultry, and a strong intellectual property regime in India. The EU wants tight origin rules in order to prevent third country goods to be shipping in via India. India, on the other hand, wants flexibility. Now, India demands its negotiations is duty-free access to its labor-intensive imports and emerging sectors like auto, electronics. Another concern for India is the negotiations is the imposition of carbon tax by the EU on imports of steel, aluminium, cement and fertilizers from Jan of 2026. The tax imposed under the CBAM could put further barriers to India's exports while tariff barriers are brought down. EU accounts for $136 billion in annual trade with India. A fast conclusion to this deal is beneficial to both parties. The talks are reportedly now in the final lap, and Commerce and Industry Minister PIYUSH GOYAL is expected to travel to Brussels end of this month for what is expected to be the final round of talks to seal the FTA deal. Well, staying with India's exports, India's exports to the United States have plunged sharply following Washington's imposition of 50% tariff on Indian exports. According to GTRI data, September shipments to the US dropped to just $5.5 billion, registering a 20.3% dip month-on-month. The figure stood at over $8.8 billion in the month of May, marking almost $3.3 billion of export trade erased from the US equation. Key sectors bearing the brunt of decline include textile, gems and jewelry, engineering goods as well as chemicals. With no signs yet of a bilateral trade deal between India and the US, the pressure on Indian exporters is only rising, even as US President Donald Trump threatening what he calls massive tariffs on India if India does not halt its purchase of Russian oil. The Indian government on its part has said that India is open to diversifying its sources of energy in its national economic interest without specifically addressing the question of Russian oil purchases. The stock market yesterday ended higher with benchmark indices Sensex and Nifty hitting fresh one-year highs, supported by strong gains in energy and select banking stocks, even as heavyweight lenders slipped post-earnings. Now, the NSE Nifty 50 rose as much as 133 points to close at 25,843 levels, while the BSE Sensex gained 411 points to end at 84,363 levels. Reliance Industries jumped more than 3.53% after reporting better than expected quarterly earnings, emerging as the top contributor to Nifty gains. Well, among other major movers, TCS also gained as much as 1.8%, while Hindalco, Titan, Apollo Hospitals and Infosys also closed higher. Now, market experts believe that the Indian market extended its positive momentum driven by better than expected Q2 results from major companies as well as the festive optimism. Some expect stability in earnings after large downgrades over the past 12 to 15 months and a strong growth in earnings in FY27. Now remember, stock exchanges BSE and NSE will remain closed today except for a special Muhurat trading session. The symbolic trading session will be held between 1:45 and 2:45 p.m. today. And yet another tragic case has emerged from Bengaluru involving an Ola Electric engineer's alleged suicide, which has now led to a criminal case against CEO Bhavish Aggarwal and other company officials. Police say a 38-year-old engineer, K. Arvind, died by suicide at his Koramangala residence on September 28th. A handwritten note recovered from the spot reportedly accuses senior executive, including Bhavish Aggarwal as well as a Subrat Kumar Das, of workplace harassment as well as mental stress. Now, Arvind's family grew suspicious after a bank transfer of 17.5 lakh rupees was made to the now deceased employee's account 2 days after his death. The brother approached Ola's HR for clarification, but claims he did not receive clear answers. Now, following a complaint, Bengaluru police have registered a case under Section 108 of the Bharatiya Nyaya Sanstha, abetment to suicide against the CEO and others. Investigators are now examining digital evidence, internal emails and HR records to verify the allegations. Ola Electric, in a statement, said the payment was part of the full and final settlement, adding that the company is cooperating fully with authorities and remains committed to maintaining a safe and respectful workplace. Time for a very short break, but coming up on the other side, all the global stories that we're tracking for you, especially the fair trade deal between US and China, potentially not moving along, and US President Donald Trump now threatening 155% tariff on China. That and more on the other side of the break.
In association with Can't Do Without Servo 40 Extra from Indian Oil. Java 42, the answer.
पढ़ता है, खेलता है, झूलता उछलता है, दौड़ता कभी कभी दौड़ कराता है, आगे आगे बढ़ता है इंडिया, अमूल दूध पीता है इंडिया।
Breaking news, major disruption is expected this week.
Yes, disruption confirmed, that's me, relax, no scams, just my brand new show, News Cosmic with Cyrus.
Being a chef, it's my priority to deliver taste in a plate with good presentation, unique innovation. You need to explore, you need to experiment.
You observe the people, make them happy, make them feel happy, and in the end you are smiling. That's the most important thing.
सन डायरेक्ट लेकर आया है एक जबरदस्त नया टीवी पैक। यहाँ असली 2 साल का निवेश, 100+ चैनल्स, HD क्वालिटी बॉक्स और रिचार्ज की टेंशन 2 साल के लिए खत्म। तो अभी लगवाइए सन डायरेक्ट, यहाँ खर्चा नहीं, 2 साल का असली निवेश।
सन डायरेक्ट सब्सक्रिप्शन पाने के लिए अपने नजदीकी रिटेलर से जल्द ही संपर्क करें और घर पर सन दनादन।
Look, this investment guru tips will double your money. Just claim the offer.
Double your money from any random group. Pay attention. Promising double returns, they'll lure you in tight. Unverified groups will send fake tips overnight, emptying your pockets before you can fight.
Well said.
SEBI and NSE advise, consult only SEBI registered advisors and make payments only to verified accounts or UPI IDs. An investor awareness initiative by SEBI and NSE.
Welcome back. You're watching News 9. This is Morning Brief at 9. Now, all the global stories that we're tracking for you. Let's begin first with US and China. Well, the United States President Donald Trump is turning up the heat on China yet again. He has warned of a 155% tariff on Chinese goods unless Beijing agrees to what he calls a fair trade deal. Trump also said any rollback in this tariff will depend on China's willingness to negotiate. He pointed to American farmers, especially soybean growers, who've been hit by China's trade boycott in the recent months. Listen in.
I think China's been very respectful of us. They're paying tremendous amounts of money to us in the form of tariffs. As you know, they're paying 55%. That's a lot of money. They never were paying anything over years and years and years. But they were like anybody else. A lot of countries took advantage of the U.S. They're not taking advantage anymore. No, China's paying 55% and a potential 155% come November 1st unless we make a deal. And I'm meeting with President Xi. We have a very good relationship. We're going to be meeting in South Korea in a couple of weeks. And we'll see what we can do.
Amid rising tensions in the Asia-Pacific region, US President Donald Trump said on Monday that he doesn't believe China will invade Taiwan, voicing confidence in his relationship with President Xi Jinping, whom he's set to meet later this month in South Korea. Now asked about a Pentagon assessment that Beijing could move on Taiwan by 2027, Trump said China knows the US remains the world's strongest military power by far.
I think we'll be just fine with China. China doesn't want to do that. First of all, the United States is the strongest military power in the world by far. It's not even close. Not even close. We have the best equipment. We have the best of everything, and nobody's going to mess with that. And I don't see that at all with President Xi. I think we're going to get along very well as it pertains to Taiwan and others. Now, that doesn't mean it's not the apple of his eye, because probably it is. But I don't see anything happening. We have a very good trade relationship. We're going to have a very good, I think, when we leave South Korea, it could be wrong, but I think we'll end up with a very strong trade deal. Both of us will be happy. I don't see that happening now.
Meanwhile, China's economic growth has slowed to its weakest pace in a year, with domestic demand faltering and exports doing most of the heavy lifting. Now, leaders in Beijing are meeting this week to shape the country's 15th five-year plan, expected to emphasize on high-tech manufacturing amid rising US-China tensions. Take a look.
China's economic growth slowed to its weakest pace in a year in the third quarter of 2025. The world's second-largest economy grew 4.8%, lagging last year's 5.2% pace. However, Beijing is still on track to hit the annual target of around 5%. Fragile domestic demand has left China heavily reliant on manufacturing production and exports at a time of mounting trade tensions with Washington. Recent export data highlights China's ability to diversify away from the U.S. market. Sales to the U.S. were down 27% year-on-year last month. However, shipments to the European Union grew by 14%, Southeast Asia by 15.6%, and Africa by 56.4%. Still, the sluggish domestic market remains a drag for businesses, with Monday's data showing retail sales slowing to a 10-month low. The prolonged crisis in the property market also weighed heavily on growth and consumer confidence in China. The latest figures show investment in the sector down 13.9% in the first three quarters year-on-year. Chinese leaders are set to hold a closed-door meeting through to Thursday to discuss, among other things, the country's 15th five-year development plan. Expected to be prioritized is high-tech manufacturing in the wake of intensifying rivalry with the United States. Investors are also looking to a Politburo meeting and the Central Economic Work Conference expected in December for clues on economic policy for next year.
US President Donald Trump signed a deal on rare earth minerals yesterday with Australian Prime Minister Anthony Albanese and said Washington's key ally would get its coveted nuclear-powered attack submarines. Now, the two leaders met at the White House to concentrate on a pair of areas, defense and critical minerals, in which Washington and Canberra are cooperating against what they view as an increasingly assertive China. Take a look at this report.
We are discussing critical minerals and rare earths.
U.S. President Donald Trump and Australian Prime Minister Anthony Albanese signed a rare earths and critical minerals agreement on Monday in their first summit at the White House.
We've been working on that for quite a while. In about a year from now, we'll have so much critical mineral and rare earths that you won't know what to do with them. They'll be worth about $2.
The two leaders said part of the agreement had to do with processing of the minerals.
Part of this deal is very specific, $8.5 billion pipeline. There'll be $1 billion contributed from Australia and the United States over the next 6 months, with projects that are immediately available.
The United States has been looking for access to rare earths and critical minerals around the world as China tightens control over global supply. China has the world's largest rare earths reserves, according to U.S. Geological Survey data. But Australia also has significant reserves, and the pact aims to ensure a steady supply of the minerals. The two leaders also said they would discuss the nearly $240 billion AUKUS agreement, a security partnership between the U.S., Australia, and the United Kingdom reached in 2023 under then-President Joe Biden.
Our defence and security partnership with AUKUS is so important for us, and I thank you for the support that the administration are giving.
The United States has a large trade surplus with Australia, which is among the countries with the lowest U.S. tariffs. Meanwhile, Australia's biggest trade partner is China, with exports of iron ore and coal underpinning its national budget, despite efforts by Albanese to diversify export markets.
And staying with US President Donald Trump, now speaking on board Air Force One, he defended a proposed beef import deal with Argentina, emphasizing its potential impact on reducing domestic beef prices in the US while supporting Argentina's struggling economy. Listen in to the United States President.
Fighting for its life, young lady. You don't know anything about it. They're fighting for their life. Nothing's benefiting Argentina. They're fighting for their life. You understand what that means? They have no money, they have no anything, they're fighting so hard to survive. If I can help them survive in a free world, I happen to like the president of Argentina. I think he's trying to do the best he can, but don't make it sound like they're doing great. They are dying, all right? They're dying.
Well, Wall Street started the week on a high note. Finance and tech stocks led the rally as strong quarterly earnings lifted investor sentiment in the US and eased worries over regional bank stability. More details in the Wall Street report.
A strong day for financial and technology shares pushed stocks up across the board Monday. The Dow and the S&P 500 both climbed more than 1% higher, and the Nasdaq rose nearly 1.4%. Shares of Apple climbed roughly 4% and hit an intraday high after a report indicated sales of the iPhone 17 were outpacing those of the 16 in the US and China. Meanwhile, a key semiconductor index also hit a record level during Monday's trading session. Jason Brown, president of Alexis Investment Partners, says he thinks this tech-led rally has more upside, but acknowledges prices have gotten frothy.
We're trading at rich valuations. At some point, these stocks are likely to underperform. We think we're still about a year or so away from that. There's still a lot of skepticism. There's still a lot of people talking about a potential bubble, which ironically tends to put it off. But we're seeing more and more speculative frenzy, and the more you've got these sky-high valuations, at least looking back historically, they've never proven justified in the past. So at some point, just beware.
Financial stocks got a lift as investors grew less fearful about regional bank credit quality. Upcoming quarterly results are expected to provide a closer read on the sector on the heels of last week's sell-off, which was driven by fears of systemic credit stress. Also boosting investor confidence was White House economic advisor Kevin Hassett, who said the federal government shutdown is likely to end this week. And in the ongoing trade skirmish between Washington and Beijing, U.S. President Donald Trump suggested easing tariffs on China if it resumes key agricultural purchases, including soybeans. Other stocks on the move included Boeing, which advanced nearly 2%. After the plane maker won approval from the U.S. Federal Aviation Administration to raise 737 MAX production to 42 planes per month. And shares of Weight Watchers surged more than 9%, following the company's announcement that it would partner with Amazon for weight loss drug delivery.
Apple's iPhone 17 series is off to a flying start. Now, according to a report from Counterpoint Research, sales in China and the US jumped 14% when compared to the iPhone 16 variant in the first 10 days. In China, base model sales nearly doubled, while overall sales of the standard iPhone rose 31% across both the markets. Take a look.
Apple's new iPhone is selling better than the previous model, according to a report from research firm Counterpoint. The report said sales in China and the US for the iPhone 17 outsold the iPhone 16 by 14% during the first 10 days of availability. Sales of the base model iPhone 17 nearly doubled in China compared to the iPhone 16 during the same period. Across China and the US, sales of the base model climbed 31%. Apple launched the iPhone 17 in September, including in China. A Counterpoint analyst called the phone compelling for consumers and a great value for the money. Separately, brokerage Evercore ISI added Apple stock to the tactical outperform list, citing iPhone 17 demand, which it said looks stronger than a typical upgrade cycle. Shares of Apple rose more than 4% to hit a record high in Monday morning trading, nearing a $4 trillion valuation.
Moving on now, luxury fashion giant Gucci's parent company, Kering, is selling its beauty division to L'Oreal for as much as 4 billion euros or about $4.6 billion. The move is part of the new CEO Luca Di Meo's plan to tackle high debt and refocus the luxury group solely on fashion. Here's the report.
Gucci owner Kering has agreed to sell its beauty business to L'Oreal for $4.6 billion. It's a major shift in strategy by new CEO Luca de Meo as he moves to tackle the luxury group's high debt and to refocus on its core fashion business. Under the deal, French beauty giant L'Oreal will acquire Kering's fragrance line Creed, as well as rights to develop fragrance and beauty products under Kering's fashion labels through a 50-year license. These include Gucci, Bottega Veneta and Balenciaga. The sale is a significant step towards reducing Kering's net debt. It stood at $11 billion at the end of June, on top of $7 billion in long-term lease liabilities, which concerned investors. It's also a major shift in direction by de Meo less than 2 months after taking charge. He's unwinding one of the biggest strategic pivots made by his predecessor, François-Henri Pinault, whose family controls the group. Kering set up its beauty business in 2023 after acquiring perfume maker Creed in an effort to diversify and reduce its reliance on its Gucci brand, which accounts for most of its profits. But the group has struggled to ramp up business, posting a $70 million operating loss for the first half of the year. The company's also battling declining growth at Gucci. It was hit hard by slowing demand in the key Chinese market.
Time for another short break, but coming up on the other side, Samvat 2082 kicks in today. What should be your investment strategies? Well, don't take our word for it, because we'll be joined by market veterans Devina Mehra, Deepak Shenoy and Mohit Gang right here with News 9's Shweta Kothari and me on the other side of the break to tell you how you should address and approach Samvat 2082. Hello and welcome. This is News 9. It's Diwali. It's the beginning of Samvat 2082 and it's the start of a new trading and investing year. To all our viewers, we wish you a very happy Diwali and a prosperous year for your investments.
And to help you discover what your investment mantra in Samvat 2082 should be, we have a very special panel of experts joining us today very, very shortly. In the News 9 studio, I am Shweta Kothari.
And I'm Karthik Malhotra. And of course, the expert panel of market and personal finance experts who would be joining us today are Devina Mehra, founder, chairperson and managing director, First Global. For the first time, we have the pleasure of being joined here by Devina Mehra. Ma'am, thank you so much for your time. We will, of course, introduce our other guests also shortly. But first up, Ms. Mehra, straight off the bat, Samvat 2082, your favorite sectors right at the start of this trading year and the ones that you think should be avoided for sure.
Okay, so let me first tell you that this is the season for everybody giving their Diwali picks. And just yesterday, I was looking at an analysis of how the Diwali picks do. And they actually do much worse than the average
Oh my
market.
God. So tell us your least favorite first and maybe we should then go ahead and invest in those.
So I mean, it doesn't make sense actually to give projections
Okay.
for, I've never given, for instance, index projections either at the beginning of the summer or in January. And I got the term for it a couple of years back when Daniel Kahneman explained that this is something called objective ignorance. These are things not only that you don't know, but you cannot know. And even in the US, where data is available for 25, 30 years, they found that all these January projections are completely off. I mean, they are not even anywhere in the vicinity of what actually happened. And this, I'm talking the biggest names in the world you heard of, Goldman and Merrill and Morgan and Citicorp and HSBC. So having said all of that, the way we manage money in our PMS, or for that matter, our global portfolios and funds, is to really forget all your preconceived notions and really look at everything from base zero every quarter. That every quarter, that today if I had money, where would I be invested? Of course, I mean, it's not as if the list completely changes from one quarter to the other, but that's the discipline to follow.
Okay, so simplify it, man. Simplify it for the viewers, somebody who's starting out.
So I will tell you where we are currently overweight. It may not last a whole year. So that was the context. So currently, like, of course, we've been overweight these sectors now for over a year and a half, have been pharma, healthcare and auto components. And we've added some auto stocks recently. This year in 2025, we have added the FMCG. So now we are overweight FMCG also. We've added to banks, but we're not overweight banks. Banks is a sector I'm always nervous of investing in, lenders in general. So, but we are holding more than we usually do. So that would be broadly where we are. We tend to avoid high risk sectors like real estate, for example, and so on. So, but nothing is set in stone. I mean, that's the biggest mistake to make, that this sector is never to be looked at, or this sector is perfect forever. So that, or for that matter, any stock. So that doesn't last. So that would be the context I'd like to give.
All right. Well, we also have with us now this very, very special show, joining us Deepak Shenoy, the founder of Capital Mind. Thank you so much, Mr. Shenoy. We also have a regular on Newsline, Mohit Gang, co-founder, CEO, Moneyfront. Shweta, your next question, if you wish.
Absolutely. Mohit, thank you very much for taking time out. Let me begin by asking you, now that we know of sectors, what are the best ways to get healthy returns in Samvat 2082? And I ask this, given that SIP inflows have been consistent, AUMs have also swelled up in the past year. So is SIP the route to take in Samvat 2082 as well?
Thank you so much, Shweta and Karthik, and wish you and everyone of your viewers a very happy Diwali. Look, I think honestly, SIP has been a time-tested instrument. It's withstood the pressures of all kinds of markets, and I think Indian retail investors have lapped it up like anything. They have taken it up as a product. In fact, they don't think so today. SIP is not considered as a mechanism to invest, but it's considered like a different product altogether. And that's how I see quite a number of mutual fund distributors and advisors, in fact, advocating SIPs to their clients. So it remains a time-tested instrument. Obviously, for someone who's a salaried class employee, a regular monthly contribution is more about disciplined savings and a habit of investments than anything else, right? And I think that habit takes you a long way. The compounding impact obviously is for everyone to see, and I think that is one trend and one habit which I wish and pray that every Indian were to adopt more and more and were to continue in the same form and fashion. Having said which, I think the markets this year has given enough opportunities even for lump sum investments by virtue of the corrections and the dips and the news flow and events which have come through. And I'm sure that's the nature of the markets, that even for the coming Samvat, we'll see a lot of these kind of events and news flow coming in and giving us opportune times to invest. So I would also advise and recommend people that they should always sit with some gunpowder. These are the kind of markets where which are highly volatile on every event, every macro news item, and somewhere down the line, perhaps you might just get an opportunity to deploy at a better level. So some portion of cash allocation is always healthy.
All right.
So
SIP is still
SIP
the best
sahi
route.
hai is what I'm hearing.
Right.
SIP sahi hai, mutual fund sahi hai, and Deepak Shenoy, it's been a great year for you. You have your own AMS now going, so congratulations on that. AMC, I beg your pardon. So congratulations for that. But Mohit Gang was talking about retail investors, and they've pretty much shown out and have really kept the markets afloat and preventing them from really stumbling very massively. But I'm not really liking the data we are seeing from FIIs and FPIs, and I want to draw this direct comparison with China, where China is receiving massive inflows, about $30 billion or so, but FIIs have been net sellers on India. They've taken out about $17 billion. So now in this sort of tug of war between retail investors and the FIIs, how long do you think the retail investors will be able to stay put, and how should they deal with this volatility that the FIIs are causing?
Thanks, Karthik. And firstly, Shweta, Karthik, wish you and all the viewers and all the team a very happy Diwali.
Thank you, sir.
Quick note over here on FIIs, they've been selling for about maybe 1.5 years now. And for the first time, we are seeing a tremendous pushback by domestic investors who've just been using, say, equity SIPs as a route to participate in the markets. And in the process, over the last maybe 2 years or 3 years, since 2022, created a position where individual investors plus mutual funds put together own more than the FII ownership in Indian equities overall. So if you divide the Indian market into what promoters own and what non-promoters own, typically 50% is owned by promoters.
Right.
Of the remaining, most was held by FIIs, maybe about 50-55%. used to, of the remaining, that was about 25% of the total, was held by FIs. Now FIs have come down to only about 17% of the total, and a significant market share shift has happened to domestic investors. This is why I think, despite the continued selling by FIs, we've had no major impact on the indexes. This is unusual. It has not happened since 2002 or so, where domestic investors have been a meaningfully larger part than FIs.
Okay.
And therefore, there are two things that happen. One is a concern that FIs are selling. Will domestic investors lose all their, all their money by having invested in the markets? I think the answer to that is they will probably lose money in some pockets, which are overvalued. But there are other pockets where markets are just beginning to show the growth. Companies themselves are beginning to show the growth. So you get a tremendous upside from where they are. We've seen this from 2 or 3 years ago. Defense companies are up 5x and 10x.
Of course.
Now, they don't have a reasonable FII participation. It's mostly retail investors that have made the money. Whereas FMCG and banks, which have tremendous amount of foreign investor participation, have not done meaningfully well in the last 2 years. And if retail investors have gone in those sectors, they've probably not made as much money in them as well. So I think those differentials remain. I would just say that India needs to participate more in India itself. So having good retail ownership is a good thing overall by India itself, because in the end, we spend the money buying the goods that these companies create. Why not invest the money in them as well and make a part of the profits as well? So I think that is a overall good thing. But there is a bigger upside to this, in the sense that India's domestic savings, if you look at a percentage of GDP in mutual funds, it's only about 18 to 19%. America is more than 100%. China is a little bit more than us.
Right.
Brazil is more than us. I think it's just getting started. So we're not meaningfully yet there to a point where we can say that our mutual funds are so big that they will, they are in any reasonable
But are you
size.
happy with the growth rate, Mr. Shenoy? Because I think the AUM is growing, the SIP folios are growing. So are you happy with the growth rate? Because AMFI's data month on month seems fairly promising.
It's okay. I mean, it's about 29,000 crores today. Roughly, that's about $3 billion, a little bit more than $3 billion.
Right.
You have to remember that America got to $3 billion in 1999.
Yeah.
Per month into equities. Now they are about $12 billion odd per month that comes into the market. So they are gone up tremendously. We are just early stage starting
Scratching
up.
the surface.
So we are, I think we will see a lot more retail participation. Markets will have ups and downs.
Got it.
I think there are parts of the market that are tremendously overvalued. Markets will see, and they will probably correct. But there's also parts of the market that I think will grow 5x to 10x in the next 3 or 4 years. And that's where there's a lot of upside. So I'm very positive long term. But you have to take my stuff with a pinch of salt, because I know it's the festive season, but I'm always going to be optimistic about the Indian market in the long term.
You've always been, sir, and primarily because of the fundamentals and the macros, but of course we will come to those as well.
Also because my money depends on it. So, I mean, my earnings depend on it. So you have to take that with a pinch of salt.
Absolutely.
Disclaimer well received, sir.
All right. And talking about China there, Divina, I have to ask you, over the year now, we've been talking about China plus one strategy, and perhaps that's the best way forward for India. Has it changed for you? Because there's been so much volatility around tariffs. There's been so much, geopolitical turbulence that the last year has seen. What's the strategy going forward from here?
Okay, this is actually mixing up a few things. But let me also address the FII question, which you had asked earlier to another panelist, and which is that, all the speculation about what FIIs will do and won't do is dependent on the fact that if FIIs, the implicit assumption is that if FIIs buy, the market goes up. If they sell, the market goes down. But actually, there has been no correlation whatsoever. And I'm not even talking today when the mutual funds are big or whether retail participation is big. Even from the time FIIs came in, when FII contribution into Indian markets went from zero onwards for the first 9 years, which was 1994 onwards. So for 9 years, the net movement in the index was zero. So all this new money came in and the index didn't go anywhere. It went up and then it came down, and after 9 years was exactly where it was. So anyone investing in equity markets should remember that equity markets, in theory, we know are volatile. but you have to be able to live through the volatility. Sometimes, 5 years returns come in a year and a half and you don't get anything for 3 years. And that's how equity markets are. Coming back to China +1, well, actually that opportunity was available good 5-7 years ago also, and we have done little, if I miss. Actually, a lot of other countries did take up their before COVID itself, places like Vietnam and Bangladesh were running out of capacity. We hadn't even got started. So finally, we are getting started somewhere. But remember, in spite of all the hype on manufacturing as a percentage of GDP in India is at an all-time low. It is at a level it was there in the 1960s. It is in the 12 to 13% range, as against about 17%, let us say 10, 12 years ago.
Yeah.
So we've actually come down on manufacturing. So we have to, go beyond just talking about it. We have to actually execute. And we are, of course, a very long way from China. We have written about this, that China is competing with the US. It is not competing with India. They are ahead, not just on sweatshop manufacturing. They are ahead on technology. They are ahead on controlling all the supply chains of all critical material. They are ahead, of course, on manufacturing, and now with extremely automated manufacturing. They have dark factories where they don't even need to switch on the lights because everything is automated. So I mean, we cannot now talk of being in the same league as China. China's per capita is 5 times ours. They stopped growing today. It will still take us 25 years, 30 years to catch up.
Right.
That's how far right the gap is. As far as Trump tariffs are concerned, there has been a lot of noise, but ultimately, I don't see it making a huge amount of difference to the Indian corporate sector, because some of the sectors that are impacted are not big from the listed point of view, which is jewelry and garments and things like that. And most of the others, for example, IT is fairly de-risked in terms of delivery, as is pharma. All the big pharma exporters to the US mostly already have their plants there.
Right.
Our skew is more towards the domestic pharma names, but I'm saying even overall, if you look at it, that's the way it is. So I don't see a huge risk. But the fact is that America can afford to arm twist India. It cannot afford to arm twist China. Because that's कहावत है ना, जिसके हाथ में होगी लाठी भैंस वही ले जाएगा. So China holds all the aces, if you want the Diwali cards equivalent, so सब इक्के उनके पास है, so they are the ones who can do this.
They've got leverage, and of course they are dealing with a joker in the pack. I don't want to mention who that joker is, but Mohit, continuing with this conversation on tariffs and trade wars, and there doesn't seem to be a realistic timeline that one can set on when all of this uncertainty is actually going to come to an end. But one is hopeful that Samvat 2082 is at least a long enough period within which one can hope for some sort of semblance of sanity to come in these multiple tariff and trade wars. So can we set a timeline for a very, very predictable upswing in the broad markets as well? Can we look at SENSEX, Nifty, the September 2024 highs to be created back in 3 months, 6 months, 9 months? Is there any science to trying to figure out when does the upswing actually become a trend that we can confidently say that, now we're in the right direction?
Karthik, look, I think predictability is a word which has long been written off from the global dictionary for some time now, and I don't think so there are any predictable outcomes in this kind of a global scenario, especially when the president of the most powerful country in the world wakes up every morning and announces a new tariff against some country or something new every morning, right? So my sense is, and even markets don't anticipate predictable outcomes. That's why markets are volatile by nature, and perhaps we'll have to all live with that uncertainty in the market for the year ahead. And my sense is that that uncertainty might keep increasing. It will keep compounding with the intensity of geopolitical conflicts, which is increasing by the day. I don't think so we will live in a scenario which is more certain and predictable. Having said which, I think the earnings in India, look, honestly, from a valuation standpoint per se, we've had a good time correction for last 1 odd year, if not a very deep value correction. If this time correction persists for another 6 months or a year kind of a time frame, or let's say even 6 months, then we are in a good fair value zone from there on, right? And I think on this lower base, the next year earnings should come at a reasonable double-digit kind of, or a higher double-digit kind of number, right? So from that perspective, I think things will start looking better for India. It's just a question of when and not if the FIIs will return back to the market. Though I understand Devina has proven beyond doubt that the markets are not so much dependent on FII flows, but I think that's one peg which has been missing for that real upswing in the market. Look, domestic flow has been fairly consistent, and that flow will keep increasing by leaps and bounds. But I think we need that bolted money from FIIs to kind of prop the market to that newer highs and newer zones. And I think somewhere down this year, we might just see FIIs returning back to our markets and perhaps markets seeing making a new high. I'm pretty hopeful that this year we will, in this Samvat, we should at least make a new high in the markets.
All right, that's
I'm hearing, Shweta, that on the consumption front we are okay. There have been enough and more reforms, so we are okay as far as our domestic industry goes. But I think our services sector is an all-new story.
Absolutely. And in fact, that brings me to IT. Deepak, IT results in first quarter were disappointing. Q2 results have also been subdued so far. Is it too early to write off IT sector?
Is it too early to write them off? I don't know. I mean, the answer of whether the IT sector will actually perform, I think has to do with the lack of level of uncertainty that we currently see in general in the US.
Is it just linked to that, Deepak, or is there fundamentally a bus called artificial intelligence which has left the station?
That the IT sector has missed?
I think these companies have seen a lot of such sectors, fads that have come and gone, right? So, tell you what, when they invented the printer, when they invented computers as a replacement to, physically doing paperwork, they said the usage of paper will come down. It has increased, of course, at a 4% per year clip since 1980s, because when you've created more computers, you've just created more avenues to use paper rather than, remove the need for paper to be used in the first place.
Correct.
I think this is also the case with AI. AI will create more opportunities for using AI itself, and a lot of that.
For consumers, for users, yes, Mr. Shenoy. But for IT companies, traditional back-end IT companies, does it not pop up as a big threat and a big elephant in the room for them to deal with?
I think you have to look at companies in terms of saying, listen, we'll get the job done better with AI, and there will be more opportunities to use AI to get their projects done better. But doesn't mean that they will, it's probably not great to be a person whose job is going to be replaced by AI.
Right.
But your job never really gets replaced by AI. It gets replaced by someone else who uses AI better. Maybe there are 10 people and you'll use only 2 people in that role.
Sure.
But the job market expands because more things can be done than otherwise. I'll give you simple examples. A legal firm today that has access to a lot of tools that has to be used in different ways. Today, there are a certain set of tools that cost a certain amount of money. There's a certain number of people that you need to hire just to be able to do a certain set of amount of research. With AI, you can do it with a lot lesser number of people.
Right.
One myopic view would be, this hurts the legal community because they will not get hired, because there will be less employment by the large legal firms.
Right.
And my contention to you is there are going to be 10x more small legal firms.
Correct, absolutely.
So I think this is also going to result in a lot of downstream work for companies who provide services to other companies in this place, including IT. But this does not mean that you should go and jump and buy IT companies right now. It's a cycle. It will take its own time.
Right.
I think these companies have seen a lot of this. In the long run, I think IT companies themselves need to evolve a lot more than they are right now. They're being a little bit more elephantish in their outlook.
Right.
They need a burst of understanding that the market dynamics are changing and change accordingly. We're seeing early
and perhaps
signs
a jolt, and there can't be a bigger
jolt.
jolt.
And the jolt is there already.
This is the jolt.
I think the Q2 numbers are pretty much the jolt which should now wake them up. So I hear you, Mr. Shenoy. I think you're saying it's going to be cheaper, it's going to be faster, it's going to be better, and the job will get done anyway. But Devina Mehra, final question to you. What is definitely not getting any cheaper? What is climbing faster than any other asset class and could potentially offer better returns, at least if you look at data from the last 1 year, is gold. So at 1,30,000 rupees per 10 grams of gold. For the retail investor, do you think the asset allocation pie needs to be rigid? It needs to be changed? And what should that new pie, if any, look like when it comes to equities, debt and gold?
And while you're on it, also run us through what are you making of exorbitant silver prices?
Okay, so first of all, don't drive looking at the terrain that is already left behind.
Okay.
That's more what you see in the rear view window.
Right.
But systematically, and we have tested this, if you chase whatever has done well off late, whether it is an asset class, whether it's a geography, whether it is a sector, you will systematically underperform.
Okay.
So never invest with a FOMO feeling. अरे मेरे friend का defense में बन गया पैसा, or they made money in gold, or whatever it is, and so let me chase that.
Right.
And I recently saw a headline saying gold is not seen a rally like this since 1979. And so let's go forward from 1979 and what happened. So gold made a high in 1980. And that high was not crossed for the next 27 years. The next time that level came was in 2007.
All right.
In between, even 19 years later, so from 1980 to 1999, gold fell 62% in dollar terms.
Right.
So gold, and even that was not a one-off. Even after that 2007 rally, 2012 it peaked, then it fell 40%.
So it's cyclical,
we've
you're saying.
actually started this. Gold is more volatile than equities. It is not a safe haven.
Okay.
So I mean, which is not to say that our grandmothers were wrong to buy gold on Dhanteras, because at that time you could not invest overseas. So effectively the only dollar asset or only hard currency asset you could buy was gold.
Correct.
So,
So what should the grandchildren do, ma'am, right
Should
now?
they buy? Should they
Forget
not
the
buy?
rearview mirror.
Grandchildren should have allocation in gold on silver, but it should not be a very high allocation, not 25-30% of your portfolio. You can have some allocation, and you should invest overseas. So you should invest globally,
Fund of funds.
at least over a time, 30% of your portfolio. When you are saving for long-term goals, that is essential. When I started working, the dollar was 12 rupees. So, that will give you some idea of what can happen to the rupee and why you should not put all your eggs in the India basket.
Absolutely.
So, over a period of time,
I think that's the classic investing advice there. I think we'll end with that. Devina Mehra, founder, chairperson and managing director, First Global. Deepak Shenoy, founder, Capital Mind, and Mohit Gang, founder and CEO, Moneyfront. Thank you very much, all of you, for taking time out for joining us on this show today.
And with that, it's a wrap, and we are wishing all our viewers a very happy Diwali and a great Samvat 82. May you have a very prosperous one. Thank you so much for watching.
एसोसिएट स्पॉन्सर बैंक ऑफ बड़ौदा के संग त्योहार की उमंग।
बढ़ता है, खेलता है, झूलता उछलता है, दौड़ता कभी कभी दौड़ कराता है, आगे आगे बढ़ता है इंडिया, अमूल दूध पीता है इंडिया।
The ultimate biking experience is incomplete without Servo 40 Extra from Indian Oil. Can't do